Welcome to NCDA's Professional Development Webinar Series. Today's webinar, New Markets Tech Credits 101, will provide an overview of the Federal New Market Tax Credit Program, including project eligibility and benefits. I'm Josh Hollingsy, Vice President of Small Business Development and Business Retention for the Wilmington Chamber and an NCDA board member. Before we get started with the webinar today, I'd like to acknowledge NCDA's annual sponsors whose logos you'll see on the screen now. These companies and organizations support every component of NCDA's expansive mission and our growing body of programs, and we thank these sponsors for their generous support. Our economic development community in North Carolina constantly seeks ways to incentivize community development and economic growth through private investment in distressed communities. Today, our webinar will delve into the basics of the Federal New Market Tax Credits, or NMTC program, including project eligibility and benefits. We'll learn more about how this location-based impact-driven gap financing tool can fill approximately 20% of the project's capital stack. I'm now pleased to introduce our speaker today, Matt Jurian. He serves as the principal of Emerald Capital Strategic Advisors, as well as Vice President of Development for Green Street Real Estate Ventures. He has over 11 years of experience in finance and banking with respect to new markets and historic tax credits and opportunity zone investments. His expertise spans the structuring, closing, and managing developments for those tax credits and investments. Matt, thank you for joining us today.
Thanks, Josh. Appreciate it. Good morning, everybody. Let me share my screen so I can get this working. All right, so you should see my my screen now, hopefully. Yeah, so Emerald Capital, we've been in, I've been in the economic and community development space for really about 13 years now. Emerald Capital is a national firm. We are focused in, incentives, funding, atypical sources of funding and capital resources. So we'll help out on state and local incentives. New market tax credits is a big federal program that we help out on. Historic tax credits will help on PACE and debt financing. We also assist with projects, maybe emerging developers that are really trying to tackle the development process. We can help them through that process as well. And then we're helping a lot of municipalities, states, universities with some of our proprietary data that we have to help them program if it's a project or a community that they're trying to improve. We have a lot of great data and resources that we're helping them out on as well. So that's just a quick blurb about Emerald Capital, and let's get into the new markets. Again, this is myself. Been in new markets for some time, got my start at US Bank Community Development Corporation, who's the largest new market tax credit investor in the United States. Left US Bank to start a consulting practice for a CPA firm called Clifton Larson Allen nationally. Ran their new markets and opportunity zone consulting practice nationally. And then through the COVID pandemic, I was approached by a regional real estate developer to join their team, but also start Emerald Capital, which is really a continuation of helping projects nationally secure incentives like new market tax credits, as well as state and local incentives. Jeff Frankel, who's also on our team, recently joined us in 2022. He actually led a community development entity for some time, Heartland Regional Investment Fund. He knows the ins and outs of the process from a CDE, community development entity, and how they navigate the new market tax credit process. And he's helping now projects navigate this program and secure new market allocations from community development entities that we'll get into, and I'll explain that now. So new market tax credits, if you're new to this program, this is a federal program. It's relatively new compared to maybe some other programs that you've heard of, low-income housing tax credits or historic tax credits. This is kind of the younger sibling of those credit programs. This was created in 2000 and first implemented in 2001. This is not a permanent program like historics or low-income housing tax credits. There's some recent legislation that's being proposed now, bipartisan support to permanently extend the program. But if not, this program is usually extended on a 5-year basis for this program. It was most recently extended for an additional 5 years at $5 billion in new market allocations on an annual basis. The last round that Treasury oversees in this program was released in October of last year. And so a new tranche of $5 billion of new market allocation has been put out into the market. And, sometime in 2023, probably fourth quarter, the next $5 billion will be released. So there's a glut of this award out there, but it's very competitive for projects. And that's kind of how we help projects navigate the system and set themselves up for best case scenario in securing this award for those projects. So let me, 1 second, gonna full screen mode. There we go. So the purpose of this program, Congress, Treasury, they saw that there was a lot of redlining happening in these low-income communities where banks were not investing, lenders were not investing, investors were not investing in these communities. And this program was created really to encourage and ultimately incentivize these banks, these financial institutions to make investments in these low-income communities. And in return, they're going to receive on their investment a tax credit. So this is really the big takeaway, the purpose, the incentive for this program. And this slide kind of drives home what's the intent. I mean, on the left-hand side, you see this is a distressed, impoverished community. It's been redlined historically, let's say. There's been little growth or economic development in this community. So the new market tax credit program, qualifies this community to say, hey, they're qualified for new market tax credits. Any project in this location could be qualified for new markets. And so it's incentivizing these financial institutions that have a large tax liability to make investments in those communities. They're going to receive a tax credit. There's an ESG component to this investment. And over time, the hope is, as more and more investments are being made in these communities, that over time, it goes to the right-hand side where the community has been lifted, right? There's quality of life projects being put in place. There's housing opportunities, mixed use projects. They want to see this community kind of evolve into a prosperous community that's thriving at some point. So that's the whole intent of the new market tax credit program. The process, again, Treasury oversees this program. They're going to announce, like they did in 2022 in October, that there's going to be awards released. The CDFI fund, the Community Development Financial Institution, oversees this program underneath Treasury. This entity will award organizations called community development entities, CDEs. There's a lot of acronyms in this program. The CDFI fund will award these CDEs new market allocation awards of that $5 billion award. Typically around 100 CDEs will win an award. There will be 300 to 400 CDEs that will apply for this award. So it's competitive, very competitive. They'll win this award. And then CDEs are ultimately the gatekeepers of this new market program. They are looking at projects, and we're working with the CDs to advocate projects to them, but they're looking at projects and saying, what are the projects delivering, the greatest bang for the buck, the greatest impacts to those communities? And we'll get into impacts in a bit, but the CDs, again, are the gatekeepers selecting which projects ultimately get selected. It is a beauty pageant contest. They're looking for biggest impacts, but also the ability to close. And we'll get into that a bit as well. The subsidy, what does the subsidy look like for a project, for a client? If you've got a manufacturing business looking to locate in North Carolina, what's the takeaway for them? The takeaway is it's flexible loans that are being given to them for 7 years, interest-only loans, and a portion of those loans are going to be forgiven after the end of the 7 years. And we'll get into that. What's that subsidy look like, that forgivable piece, in just a bit as well. For the investors buying these tax credits that are generated, they're going to get a 39% tax credit based on the amount of awards that the CDE is giving a project. So if you have a CDE giving a project $10 million of new market allocation, it's going to generate $3.9 million of credits for an investor to buy those credits. The CDs are ultimately the sellers of those credits, and I'll dig into a high-level structure and just showing you how the money makes its way down to the project and ultimately the subsidy to them as well. This is kind of just showing a streamline of credits that are delivered for the investor over 7 years. It's a 39% tax credit, but it's not received in 1 year. It's over 7 years. So first few years at 5% and the remaining years at 6%. Again, the benefits of receiving new market tax credit financing for the project, they're going to receive a significant benefit at the end of the 7 years, but there's also upfront capital for the project through the sale of these tax credits for their project. These are program definitions and acronyms. Again, there's a lot of acronyms in this industry and this program. Hopefully we'll be able to send a PDF of this presentation, so you can always have this as you're talking to companies, or if you're ever participating in this program, you can always refer to this. And what is a QUILIC? What is a QUALIC-B? What is an LIC? So that's just something we keep in our presentation deck for reference down the road. We won't dig into it too much today. Here's a typical structure for a new market tax credit transaction. So if you have a client, a project that you're working on, a manufacturing business that's looking to locate or grow in North Carolina, they're going to be that bottom green box. They're going to be receiving all, the funding. There's this intermediary aqua box that's called a subsidiary CDE. That's that entity that I mentioned receives from the CDFI fund underneath Treasury this allocation award. And then at the top of this structure is the new market tax credit investor buying these credits. So let's use a $10 million, let's say we have a client that has a $10 million project. Let's say they're creating, 100 jobs. They're going to be good paying jobs above a living wage. A lot of accessible jobs they're creating. And this CDE that has a $10 million award from Treasury, this allocation award, likes this project, says, hey, we like what you're doing here. We like the story, the impacts. We want to give you our $10 million new market allocation award. Well, what does that mean? So basically that means they're committing and this new market allocation award of $10 million that's going to generate $3.9 million of new market tax credits to an investor. So you see at the top black box, $3.9 million of credits are going to be sold to that investor. As I mentioned, those credits are streamed to the investor over 7 years, so they're not going to pay a dollar for dollar for these credits. They're going to pay a reduced price. Right in this model, we're saying they're going to pay about $2.8 million of capital for those credits upfront. That's paid on day one. So they're going to buy those credits on day one of the closing, the new market tax credit financing, for $2.8 million. That $2.8 million is invested in this investment fund vehicle that commingles the funds that we need to support this new market allocation award. They'll put that $2.8 million into this investment fund, but what we need is $10 million flowing through this new market structure. So typically the project is already borrowing. They already have some debt they're programming. They're probably putting in some equity. Maybe there's some grant proceeds that are up front that they can utilize. But basically at that top left, I'm saying a bank lender, I'm making it easy. They'll commingle their funds that they already have for their project and make a loan through this new market structure, the project, the client of that manufacturing business, what have you. They'll make a $7.2 million loan to round out a total need of $10 million in that investment fund box. Because we have $2.8 million from the investor buying those credits and now $7.2 million from the project's other financing that they've commingled. We'll now have $10 million at that investment fund box. That investment fund will make an investment called a QEI, qualified equity investment, into the CDE. And it's at that point in time that the tax credits are generated. We need an investment from that investment fund to the CDE of 10 million in order to generate those $3.9 million of credits for 7 years. The CDE will receive that 10 million. And this is the way the CDE makes money in this program, because when they're awarded from Treasury, this new market allocation award of, let's say, 10 million, it's not real money that they're winning. It's just rights to finance, to be that intermediary entity of the money to flow through them to generate those credits. So the way they make money in this program is they charge an allocation fee, typically up front. It's around 4%, 4.5% of the new market allocation award. So 4% of 10 million, they're going to charge around $400,000 at closing for their $10 million award. So the investment fund makes that $10 million investment into that CDE. The CDE takes a fee of $400,000, and the remaining proceeds are then loaned to the project in 2 loans, typically, a loan A and a loan B. The loan A is always going to equal what the project is putting in. That 7.2 million at the top left is going to typically be right sized to that loan A of 7.2 million, because that's what they're putting in the deal. The takeaway is this 2.4 million loan B. That 2.4 million, the back end of how we got there, it's 2.8 million that the investor is buying those credits for, minus the 400,000, equates to that $2.4 million loan B. At the end of the 7-year compliance period, that loan is forgiven. Typically, I would say 98% of the time. There are a couple CDs that operate in this program that do something a little differently, but I would say 98% of the time that loan B is forgiven after the end of the year, a 7-year compliance period of this program. So the takeaway is they're using their existing funding of $7.2 million, flowing it through this new market structure and generating $2.4 million of upfront capital for equipment purchase, working capital needs, construction of the real estate, expansion of an existing facility, rehabbing an existing facility. Really, there's not a lot you can't do with these funds, but it's 2.4 million of upfront capital for their project. And that loan is forgiven after 7 years. And then the next question I typically get is like, okay, well, these 2 loans to this project, who are they making those interest payments to? Well, not to get overcomplicated, but we'll right size the interest rates on both that loan A and loan B to stream interest payments to that bank lender on that $7.2 million loan. The CDE will collect interest payments, push those funds up to the investment fund, and ultimately the funds get streamed back to whoever that true lender is in the project. So the investor is not collecting any interest payments. The CDE is not pocketing any interest payments per se. They do have some fees through the compliance period, asset management fees, but they're not really related to the interest payments being made. So that's kind of the quick takeaway. The capital stack example, I think this is more clear for projects when they're looking at this. If I have a project that I'm programming, a $10 million project, and I'm going to acquire land, do some construction, buy some equipment, and fund my soft costs, maybe I have a $10 million project. Well, before new market tax credits was implemented in my sources of funds, I probably had to raise an additional amount of debt or put in more equity into my project. Baking in the new market tax credit program, I'm going to get $2.4 million of upfront capital. That's ultimately a loan, interest-only loan that's forgiven after 7 years. So I'm going to be able to reduce my debt from maybe 6.4 down to 4 million, or reduce my equity outlay, or it's a blend of both. Maybe I'm reducing my equity and debt to plug in this $2.4 million capital injection. So that's the big takeaway for projects, is this upfront subsidy that's available for construction, equipment, procurement, even acquisition of land, soft costs that they need to fund. That $2.4 million can be spread over all those buckets of funds that they need to use for their project, or it could be even targeted just to one specific bucket if need be. So the big question is, like, how do we qualify for new market tax credits? Well, it's a place-based program. You have to be in a qualified census tract. So the CDFI fund It's on their map. They have a mapping system. It's based on poverty rates and median family income. North Carolina has a lot of qualified census tracts. So there's a lot of opportunities for projects to locate in these communities. Sometimes you'll be surprised of which census tracts are actually qualified. The data, the qualified census tracts are really based on 2015 census data. 2020 census data is going to be implemented this spring. So there's going to be a refresh of the maps fairly soon. But yeah, so you have to be in a qualified census tract to qualify for the new market tax credit program. And there's different layers of eligibility or qualification. Here's an image of the city of Nashville in Tennessee. CDEs are incentivized to give their allocation to projects located in what's determined to be severely distressed or non-metro census tracts. And how do we get to a severe distress? Basically, you need poverty, one of the three. You need poverty rates to be over 30%. You need your household income in that census tract to be below 60%, or you need an unemployment rate 1.5 times the national average. And then the fourth bucket is if it's in a non-metropolitan census tract. There's a second criteria to qualify for severe distress, but it takes more of a dig and analysis. If you're working with a client, the quick takeaway is send us an address. We can look at it, do the due diligence, and let you know if we can get to a severe distress based on first or secondary criteria, because it is paramount to be in a severe distress census tract. CDEs, when they're applying from the CDFI fund for this allocation award, are typically required to invest their allocation award. You know, I think they're more incentivized, over 95% of their award, to be in these severe distress census tracts. I think the bare minimum they typically are looked at upon is 85%, but it's getting so competitive, where I mentioned only 100 CDs won allocations out of 400 that applied. They're kind of ramping up on their competitiveness, where they're trying to increase that percentage of investments in severe distress. Some are 100% in severe distress census tracts that they have to invest in. I have a question. I'll stop here and answer a question. So new market tax credits have been a tool for many years now. Has there been a resurgence in the use of this tool? Also, where do you see it being used most effectively? Great question. It's timely because it's no secret. I mean, we're in a recession environment right now. Inflation's rampant. Interest rates on traditional bank debt is ever increasing. We're seeing more and more interest in new market tax credits now, because a year ago, I could go to a bank and I could probably get an 80% loan to cost loan at 3.25% interest rate. Now the world is turned upside down. Banks are now saying, well, maybe we're at a 65% loan to cost. Maybe we're at a 70%. So the amount of debt available is decreased. And then they're saying, well, we were at a 3.25%. We're now at a 7.5% interest rate. Maybe it's higher. So our debt service has gone up. Our NOI that we're paying on that debt service is getting dragged down. So everything is changing. The world is changing in our financing tools. So new market tax credits is now being looked at ever more so as this tool to implement to reduce the debt, reduce the equity. Additionally, companies are looking to pocket a lot of cash and hold on to that as working capital needs over the next 18 months or so from companies that we're talking to. So this new market tax credit is a nice tool in a recessionary environment, as it's reducing the capital outlay from the project and the need from a bank, traditional lenders, to allow a project that's already been programmed to move forward. Now, there are projects that maybe have been in an idea stage to say, we're going to put a pause and wait 12 to 18 months, but there's a lot of projects that were already committed. They're already spending, fees, and they need to ramp up their operations to meet growth or any kind of demand. They're moving forward, but this tool is going to be a nice resource. It's also a nice resource for nonprofits. I'm talking about manufacturing and operating businesses, but nonprofits, this is a fantastic tool because in a recessionary environment, if I'm a community center and I'm raising donation dollars in a recessionary environment, it's pretty tough. People are hanging on to cash right now, not making those philanthropic investments. This is another tool that helps them out in a recessionary environment. Even in a non-recessionary environment, it's been, you know, a high demand program. There's only $5 billion of allocation released annually, and I would say there's probably an ask from the community of projects asking for new markets. It's probably in the 10 to 15 billion range, if I had to guess, if not more. Yeah, I think I addressed that question, so feel free to follow up if I didn't address that fully. So keep moving on here. Project selling points. I mentioned at the beginning of this that it's kind of a beauty pageant, and it really is. I mean, it's no different than some of the incentives that North Carolina, you know, the job programs that North Carolina has. There was like some of the discretionary grants that you all have, like the job development investment grant. A lot of the impacts that these CDs are looking for are job related, especially if it's a manufacturing operating business. We've seen evolutions in the program. At one point, there's always like a new hot topic that the Treasury Department or CDFI fund would like to see funded more. And at one point, it was like healthy food access, food deserts. I would say over the last 5 to 10 years, it's been job growth, job creation has really ramped up to be like #1 thing that they look for. And it's not just job creation. They're looking at the quality of those jobs. Are they paying above a living wage? What's the accessibility of those jobs? Are those people that are looking for this job at this new manufacturing facility, do they have to have a 4-year degree, or is it below a 4-year degree that they can get a good paying job? And then the opportunity for advancement as well. What's that look like over, you know, the time of their employment? Are there, you know, opportunities to advance in that company? Are they paying benefits? We look at a wealth of data and information, and ultimately to advocate for that project to the community development entities that are reviewing a project and seeing who's worthy of this award. They look at environmental impacts. That's starting to grow ever more so. Looking at the green nature of a given project. Is it a manufacturing business that's, you know, a disruptor in their industry where they're providing this new green technology? They look for that kind of angle as well. Is this project a part of a broader development? Is this like a first mover project that's going to create housing and, you know, quality of life projects? They want to see that their initial investment is creating impacts over, you know, the next 5 to 7 years. Assistance to low-income communities, and then assistance to minority or women-owned businesses. There's a growing and ever more so growing number of CDEs that are looking for projects that are either minority-owned, it's a nonprofit that's minority represented on the board, a majority minority board representation, or it's a real estate development project that has favorable lease terms to minority-owned businesses. So that's an ever-growing focus that we're seeing in the market as well. But I think the #1 is still jobs. Anytime we're talking to CDs, especially in operating business, it's what's the job impact there. So here's a list. It's not a full encompassing list, but it's pretty robust. A list of typical projects. I would say we see a lot of manufacturing projects. And again, it kind of drives home what CDEs and ultimately Treasury is trying to focus on: jobs. They want to see jobs in the United States. I know President Biden wants to see more reshoring of companies, and so they're wanting to see that narrative as well. But the jobs are paramount. I mean, I have another question. Oh, yep. Max, I'll make sure that this PowerPoint is sent out. There's a request for the circulation of this PowerPoint. I'll send this PowerPoint out, this New Market 101, as well as some other good information. This is a list of typical new market tax credit projects. Manufacturing, healthcare is a big one as well, especially in rural communities. We're working with a lot of healthcare projects in rural communities because what's happening, it's kind of it's a crisis. These rural communities, their healthcare systems are failing or crumbling, and they need more investment in these healthcare communities, these healthcare projects in those communities. A lot of times people are having to commute to more of the urban areas for those healthcare needs, and we're wanting to see more resources put back into those rural communities. There's also an opioid epidemic, and I know the New Markets community is really focused on supporting projects that are supporting those kind of projects. But this is an encompassing list of typical projects that we see in this space. Again, manufacturing operating businesses are, I would say, key number one thing that we look for as well. Ineligible activities, we have to touch on this. So there are a list of projects you cannot use new market tax credits for. You cannot fund a pure residential project. We get calls about this all the time from developers saying, hey, I'm doing a workforce housing project. Can I get new markets? You cannot. You can do mixed use though. And so if you have a ground floor or a couple floors of commercial space, we can make that work. You cannot fund golf courses, massage parlors, racetracks, hot tub facilities, gambling facilities. We call these the sin businesses. So you cannot fund these projects with new market tax credits. So here's some other factors, and this is really timely and a focus for the state of North Carolina. These are factors that attract additional allocations to projects. Every year, the CDFI fund puts out a list of 10 states that they feel are underserved with new market tax credits, saying that there are not as many deals being funded in these states, and they want to see more done so. And so they're incentivizing these CDEs with an award to invest in these states. North Carolina is on the list this year. So there's going to be an enhanced focus in the state of North Carolina to deploy a portion of that $5 billion in the state of North Carolina. So this is timely. If you have projects that you're working with, they may already be going through their capital cycle, or as far as putting their capital together, or they might be in design phase. I don't know, wherever, but it's worth looking at because there's an enhanced focus for North Carolina projects to get funded. An additional layer, the CDFI fund, again, that's underneath Treasury that oversees this program, want to see more non-metropolitan projects funded. There is a focus in more rural projects getting funded because they're seeing a displacement of funding for those projects in rural communities. They want to see rural communities impacted more so through the new market tax credits than historically have been. So there are CDEs that check a box when they apply for this award to say, we're a rural CDE, we're going to fund at least 20% of our allocation award from the CDFI fund to rural projects. So if you are working with a rural project in the state of North Carolina, you probably have a really good beauty pageant contest for your project if you're creating impact. So it could be a really good story there. So those are just other factors that we look at when we look at what's the competitiveness for this given project. If you meet an underserved state, and especially if you're in a non-metro county, there's a good fact pattern for you. Even if you're not in like a non-metro, if you're in an urban setting, urban deals, I think, get the lion's share of new market allocation. So I would say that does not disqualify you by any means. So here's kind of like a best practices approach of like how we work with clients, how we help projects. We like to project manage alongside, the Economic Development Agency and everybody else that's on the team to get them to success and get them funded and closed. It's getting our capital stack is number one in place. New market tax credits will be your last capital dollars in. When a CDE looks at the deal, they'll say, okay, so you have debt, you have equity. Tell me about that debt. Do you have a term sheet for that debt? They're going to look for that. That's a baseline thing that they look for before providing a commitment. They're going to look at the equity and say, do you have proof that that's available? How is that going to be invested in? They want to make sure that the new market tax credits that we're asking from that CD for, they're the last dollars in, alongside with some of those state and local incentives. Community approval. We want letters of support from senators, governors, mayors, local economic development agencies to show that the community, the state, the city, the municipality wants this project to be in their community. They're supporting this project. The CD doesn't want to give an award to a project and then find out some bad news article of like there was pushback for this project to come to this municipality. Having your team in place is critical. We like to set up, you have to have your architect online. They should be well under design phase before we're starting the new market tax credit closing process. You want to have a general contractor. You don't have to have your GMP contract per se in place up front, but hopefully we're having those discussions and we've identified at least who that GC is going to be. Consultants, all the consultants should be, you should have a good team around you, around the project, whether that's economic development agencies or a new market tax credit consultant, capital sourcing consultant, what have you, a good accounting team and a good legal team that's well-versed. I strongly emphasize, and we always provide resources of good legal counsels that we like to use, but you should have a good legal representation that is well-versed in the new market tax credit space, that's done this a number of times, because you don't want to pay for their brain damage in learning about this program. And then number 4, and it kind of ties into all these other things, is being shovel ready. It's having your plans and drawings done, ready, your funding in place, contracts in place. If you're a startup business and you need to have your LOIs for who's going to be buying your product in place before we close. Permitting as well. We want to be shovel ready. As soon as we get the funding in place, we're off to the races on construction, if it is a construction project. Question I have: rural communities do not have staff to chase this. What if they have a project and no investor, say healthcare and no investor? Well, that's where we come in. I mean, you can make an introduction. If there's a project that you're thinking about or about, that's where we fit into the cog and wheel. And I come from a rural community. I understand the lack of resources there from a rural community's perspective. And so that's kind of our whole mantra as well, is we want to be that resource to help those rural communities. Working with a rural healthcare facility in Southern Tennessee, and they have a healthcare project that's very similar. They don't have the back office at the local economic development agency to help further this. And so they're bringing us in to be that consultant for the project, for the hospital, to secure the investor for the new market tax credits, secure the CDE. So that's kind of where we fit in that cog and the wheel. Next, I'd like to give a kind of a business case example of a recent project that we worked on. This was a mixed use project in St. Louis. We secured 18 million of new market allocations for this project. It was about a $20 million project. Mixed use, had retail and office space. It's a catalytic development, kind of what I mentioned earlier. It's kind of the first mover in this area that was historically industrial. A lot of these old buildings, these businesses went out of business, and some of these old buildings have just sat vacant. Well, this developer came in, programmed this really cool new product in St. Louis called Bar K. It's a dog park meets a bar restaurant. It's creating almost 150 jobs there. And there also is office space in the front of this building that's creating an additional 85 to 100 jobs. There was a lot of construction jobs generated, 150 FTEs. So it was a really good story for community development entities to provide their allocation on. And this is kind of tying to that original example I showed you of how this came together. It generated about $7 million of credits. The investor bought those credits for almost $5 million. The project, the developer put in, commingled their fund, their bank debt, equity. There was some opportunity zone investments, some PACE financing involved, but they put in 13 million into this investment fund vehicle. We pushed down 18 million. And then at the end of the day, they're going to get a $4 million subsidy, a forgivable loan at the end of the 7 years. So it was upfront capital that they didn't have to put into the deal of $4 million. That was not their own funds. They had to put in 13 million, and they got 4 million coming from the new markets. It got them over the hump. I mean, this project could not have moved forward without new markets being a part of it. They just couldn't get the bank financing. They were tapped out on as much equity they could put in. They had PACE financing. We really commingled a lot of different resources for them. But it ultimately, with the new markets, got them over the hump of that $4 million of capital injection from the program. So that's kind of our quick 101 takeaway. Hopefully I didn't go through that too quickly. My contact information, Jeff's colleague Luke Pope, also our contact information is here. Feel free to call us, email us. You can't bother us. We love talking new markets. We like talking deals, and we can talk about any nuances that you might be working with and seeing how we can help. And it's not just new market tax credits. We could be talking about some other incentives. It could be real estate development questions. We have a sister company that's a real estate development company, and we have a lot of those back office resources that we can help out on. So I don't know if there's any additional questions.
Yeah. So I'll chime in here, Matt.
Yeah.
Thank you for the initial introduction to new market tax credits, and we do have some time for questions, and I've got one actually, and I can maybe kick it off and see if we have any others from the audience. One thing that I'm seeing in my community in Wilmington is we do have some projects in distressed census tracts, but they're existing buildings with machinery and equipment, like existing companies that have failed or available for sale. Would new market tax credits be eligible for purchasing existing buildings and equipment in census tracts? Is that an opportunity?
Potentially. So you can purchase an existing building. They typically like to see, if it's a real estate play, they like to see that you're doing some kind of rehab to the existing facility. They don't want to see you just buy a company and just continue operating as is. They want to see an enhancement, an improvement. So you could be buying this building and equipment, but also making some improvements to the facility. Maybe you're buying some additional equipment in addition to the existing equipment, or refreshing that equipment. That's typically what they like to see. They like to see some kind of enhancement, improvement with the existing operations or business or building per se. Does that make sense?
Mm-hmm.
Yeah,
it does.
Okay. Also, there's no other questions here. I mean, I can just show you some examples, some recent projects. Most recently, we funded Climate by Design in Owatonna, Minnesota. This was a rural manufacturing project, HVAC manufacturer, securing $27 million. Just to kind of give you an idea of recent projects that were funded, 200,000 square foot facility that they're building, and they're going to buy equipment, working capital needs for the project as well. Really excited about what that group is doing. Thor Boats, which was a startup boat manufacturing, hunting and fishing boat company. We helped them raise the new market tax credits, but also other financing to help them really get up and running with their operations. So that was another rural operating manufacturing project that we worked with. And Holstone, which is in Fremont, Nebraska, helped them. They bought an old Hormel pork processing facility, and now they're going to expand and modernize a facility that's from the 1960s. So we helped them secure new market tax credits for their operations. Tiger Fiber, they're in Sauget, Illinois. They're a commercialized hemp manufacturer, and they're a startup as well. They were a startup. And so we helped them get off the ground and running using new market tax credits as part of their capital stack. So that's some representation of operating manufacturing businesses. We also help with real estate. Here's another mixed use office retail that we helped in St. Louis. Nonprofits that we help out, Meals on Wheels in San Antonio, Texas, for their new 45,000 square foot facility. That's going to be an expansion of their kitchen so they can make more meals and deliver more meals to the community they serve. So just a representation of recent projects that we have assisted to become, successful and get over that hump with their capital needs.
Matt, another question. Yeah, I think you mentioned North Carolina is maybe underrepresented in the new market tax credit system. Do you have any thoughts on why that might be, or
it's based on per capita. So they look at like total investment using new markets in a given state, and then take it and compare it per capita, like how many residents are in that state. Like an interesting fact is like Texas and California are considered, underserved, which is kind of crazy because we see a lot of activity there. North Carolina, we're seeing a resurgence of CDEs focus going towards North Carolina. I would say in my time, there's been little to none on the CDE front. That a CDE that's like, hey, we're just a North Carolina CDE. That's all we do. Recently, there have been some new CDEs that have been getting awards saying North Carolina is part of our mission, our story. We're going to fund North Carolina. And so I think the CDFI fund is trying to get more of those CDs to kind of list North Carolina as a state that they're going to serve. But I think historically, like the question of like why, we've seen a lot of the Southwest, Southeast, like the Tennessee markets, we've seen a lot of allocation going to some of those markets. And then on the coast, as far as like California, New York, Northeast, we've always seen historically a lot of investment just because naturally a lot of these CDs are out of those markets. But now we're starting to see a resurgence of community development entities kind of saying North Carolina is one of our focus states. So that's good to see.
Is there a list of deals that have been done in each state?
Yeah. It's not all encompassing, but there's the New Market Tax Credit Coalition is a group that kind of advocate for the New Markets program. They have put together, it's not an all-encompassing list. It's really a list that they try to get from the community saying, hey, send us project details that are getting funded, but they're memorializing all these projects at the New Market Tax Credit Coalition. So you can search by state to see an example, a representation of projects funded in the state of North Carolina. And I can help share that and circulate that to the group as well.
Perfect. We've got a question here from the audience that says, it's from Stephen. This may have already been stated, however, is there a listing of companies that work directly with new and expanding companies per this program? I'm assuming Matt's one of those, right?
Yeah, so we're one of those. I don't know if there's like an all-encompassing list that memorializes that. So we're one of those groups that work with those kind of companies. It's not a large industry. I would say there's probably 10 to 15 groups that do this nationally. But yeah, unfortunately, I don't think there's a list, but we're one of them if you have a project.
No, it's interesting because, just in my experience of working in these census areas, it's not always the case where you have a consultant or a specialty firm that this is what they do on a daily basis. It's right. What I've found is it's usually in a bank, in a division, and it's just one of the pieces. So it's kind of an interesting.
It's why I got into this space and this business, because I was at US Bank Community Development Corp on the investor side buying the credits, and I saw a lack of resources for projects. It always seemed like it was repeat business or repeat customers, repeat clients that knew about new markets, and they kept going back to the well and using new markets in their projects. Where I saw a gap in the market where like rural communities, like a question that was asked earlier, even in urban settings of maybe it's a business that has never expanded or built a new facility, they have no idea that new market tax credits exist, and they're missing out on an opportunity where there's these, other companies, these Fortune 500 companies that have deep back offices in the finance department that know about this program, that are using it quite regularly as they're doing their expansions across the country. So it was kind of that's why we started Emerald Capital, is to be that conduit for smaller businesses, but also larger businesses that may not know about new markets, and nonprofits as well is a big piece that we work with. So
do you find that banks will come to you to help them through that process?
Quite regularly. We have a really deep network of banks nationally, and a banker will have a client, and it's like I mentioned earlier. I mean, a banker will have a client. He'll be like, Matt, a year ago I could do the loan that they're requesting, but I'm capped. I cannot go above this threshold. Does this project qualify for new markets? Can we use new markets in this? And if the answer is yes, then we get, the bank will introduce us and we'll help that project secure new markets and other incentives that can kind of round out their capital stack that they need to fund this project. Lawyers as well. I mean, we get brought in by lawyers, bankers, others resources. Another question I see, does your company help new and expanding companies determine eligibility on the front end? Absolutely. So I would say, like, I think I mentioned this earlier, may have not. Send us an address. You can just send us an email, call me, text me an address, and I can, do the due diligence, look it up. It may not be it may be qualified, but not severe distress, like what I have up on my screen on the first criteria, meeting one of those 3 buckets. But there's a second set of criteria that we can get it to severe distress, and we can do the due diligence to qualify it. So send me an email with the address, and we'll get back to you within 24 hours for sure on the eligibility.
Well, we're running up on our time, but one last question for you. I was just kind of curious what maybe your favorite project that you've worked on might be in this program.
Man, that's a tough question. This is why I love new markets, because just the projects I showed, it's all kinds of industries. I'm helping Thor Boats that's in the hunting, fishing boat industry one day or for a year. And then the next year I'm helping, Climate by Design, that's an HVAC manufacturer. I'm learning about all these industries that I'm not familiar with. And then I'm helping a Meals on Wheels that's got a really strong mission of supporting senior citizens, and they're battling, that whole crisis of affordable housing for senior care facilities, where they're trying to prolong the ability for those senior citizens to stay in their homes by delivering meals to them. And so I would say that Meals on Wheels was pretty special in helping them. But the projects like Tiger Fiber, that's a startup commercialized hemp manufacturer that's first of its kind in the United States since the legalization with the Farm Bill of hemp processing and growing. That was a pretty special project, I would say, as well.
That's awesome. Steven's got one more question. Do you also work with companies on the Opportunity Zone program as well? Yeah.
So colleague of mine, Luke Pope, and I, we really were out in front of the Opportunity Zone space when we were at Clifton Larson Allen, and grew that practice to what it became now, one of the leaders in the OZ space from a capital source and also advisory role. We still continue that service. We help out projects structure and kind of navigate that process, because it's a bit complicated. But yeah, we still provide that service. Absolutely.
It sounds like you and Steven need to connect after this. Yeah,
but I agree. Yeah. Yeah.
Well, Matt, wanted to thank you for this opportunity to come speak with our membership, and appreciate your engagement with NCEDA and taking time out of your busy schedule to help us through this process.
I appreciate it, and I look forward to the upcoming conferences to see and meet people in person. So looking forward to it.
Perfect. Well, thanks everybody. That'll be it for us.
Appreciate it.